Morning. This is a very exciting topic for me to moderate. I was just going through the whole process of understanding how capital flows are affecting the entire climate space in this country today. Turns out that the whole capital continuum, it's a bit of a tongue twister. The climate capital continuum. We in financial services are very used to using 3C, 4C, D, so it's a little bit of a courtesy. So I'll say the 3C, the climate capital continuum, ensures that money flows from early stage to MSME transition to late stage funding as well. And I think one of the most important things is that, in fact, two things. One is that if money flows out, money dries out at any stage, I think it affects the entire funding process. And the second thing is that there are different participants for different stages of capital continuum. We are actually very fortunate enough to have panelists representing all three stages today. And while I'll start off the questioning, but I just thought I'll give you a perspective. When I was going through this entire topic and I was studying about climate capital continuum, it actually reminded me of a one-day match. You know, a typical one-day match, a one-day cricket match. It's still in fashion, by the way. Just because we've not won the World Cup doesn't mean it's not in fashion. It typically starts off with, an explosive sort of a run rate being created. It's pretty much the seed or the start of the match. The run rate in the beginning actually starts off and decides the fate of the match pretty much. But more importantly, you have the middle overs, which actually talks about more or less MSME, transition sort of, transition acclimatization towards the capital climate change continuum, which actually defines what the match is going to look like. More importantly, the slog overs decide the pace at which you're going to win. Ultimately, you have to reach the finishing line. So the slog overs, which is where most institutional investors come in, credit comes in. So it's a very interesting sort of an analogy I could come up with. So from that point of view, let me just dive straight in. And let me talk to the first opening batsman, if you will, Mohit. Okay. Mohit, why don't you just quickly introduce yourself before I ask the question?
My name is Mohit Dhawan. I run the investment business for Hero. And climate tech is one of the core areas of our investment thesis. And it's been a bit of a challenge to find, at least in the last couple of years, strong business models. But we are seeing that a lot of good strong business models are emerging, and I think the next 25 years should see a lot more of them.
Actually, you
Preempted your question?
preempted my question. So my question, just to be very specific, is what are the macro environment signals that you're seeing? What are the business model realities? What are the deployment status facts that you see out there? If you could just give a lay of the land.
Sure. Yeah. Look, climate transition is here and now. It's the next multi-billion-dollar private markets opportunity. Just like technology defined the last 25 years of investment cycle, we feel that for the next the next 25 years in the VCP ecosystem, climate tech and decarbonization will define will probably be a part of the central core theme for the next 25 years. So every major value chain, call it energy, mobility, materials, food, logistics, real estate, is being rebuilt. And this provides, in our mind, a lot of repeatable investment opportunities that essentially fund managers can leverage to create alpha in their portfolio. And the second thing I wanted to talk about was there's a massive capital gap. From some estimates, global requirement of capital for decarbonization can be anywhere between $5 to $6 trillion a year. And where we have currently, we're significantly lower in terms of supply of capital. So that should create massive opportunity. This demand-supply gap should create a massive opportunity for private market investors to play. The other thing I want to talk about was, look, climate tech, like I said, has moved from being the frontier tech to more of a mainstream investment theme. And there are a lot of good investable businesses, ideas that you're seeing these days. So when you think about it, if you've seen last 2, 3, 4, 5 years, the costs in renewable storage, EV, mobility, hydrogen, biomaterials, all of those have become significantly lower. And now, at some level, they are starting to compete with the traditional materials that we used to use earlier, and which has created a lot of business models that essentially are unit economics positive and provide good investable opportunities. And the last thing I want to talk about was, look, in terms of for private equity investors, there is a lot of play. This whole climate tech theme has moved beyond the ESG add-on that we used to think about it, right? It's become more mainstream, and decarbonization now is affecting cash flows for investors, which effectively are impacting returns, and hence are front and center of any investment decision or any investment committee conversation. And lastly, look, emerging economies provide a lot of decarbonization delta. So the next set of opportunities, the investments that we make today, will define whether the systems of tomorrow are clean and efficient, or we end up doing things the way that we were doing the last 50 years. So my sense is there's a lot of opportunity for the private market investors to make a lot of delta in the next 25 years in this space.
I'm listening to you and I can't help but ask you this question. I actually saw you interact with some of the startups outside. As a family office, I'm just taking you as a representative of the family office segment. How much of your decisions to invest in a segment like this is more commercial driven, and how much is it responsibility driven? Because you fund early stage businesses, right? So,
early and growth, yes.
Right. So what is the commercial angle to it, and what is the leap of faith angle to it? What proportion of it would it be?
See, Vikas, you cannot make an investment without being an eternal optimist, right? Rajat there is nodding his head. So every time, even if you are making investment into a very traditional business, as traditional as FMCG, you are taking a leap of faith, right? But when it comes to specifically answering your question about climate tech investments, look, ultimately, what I always say is investment analysts are very good accountants, okay? So if you are able to look at the P&L of the company and understand that there is a sustainable business model in this, that leap of faith becomes much easier to take.
Interesting.
And from the last specific question about us as family office, look, we value the core beliefs of our promoters and our shareholders, which is the Hero family. And our group has long stood for protecting the environment, for doing things beyond the immediate P&L. So we do look at, while we do look at opportunities and from a return lens, there is a very strong broader good of the society overtone to every investment that we end up making.
Thank you for that. So I'm just going to your other opening partner here, which is Satish. Satish, you run the Neve Climate Funds. And whenever we've spoken, you've not extensively, actually, you've touched upon that. My sense is it's an extensive undercurrent about the value of debts between seed and growth funding, right? How would you describe the current stage-wise funding landscape across early growth and late-stage climate investments?
So, first of all, thank you very much for inviting here. And see, when we think about the climate finance continuum, the landscape, it is actually unfolding across three very crucial stages, like where Mohit invests, then we invest, and the other guys also invest. First is the seed stage, where the typical deal size will be around $1 to $5 million, and rightfully said by Mohit, like family offices, the early believer, and angel investors basically invest into that. Then second is the growth stage, where typical deal size is around $5 to $30 million, where climate-focused fund, impact-focused fund, and some of the VCs, they believe in the strategy they invest into. Then finally is the late stage, where $30 million plus deal happens, and late stage PE and platform-focused funds basically invest into that. So if you think about, and if you've seen the data the last 2-3 years, you know, talk about from 2023 to 25 currently, around 12% deals in the entire PE funding, I'm talking about only equity funding, has happened in the climate sector space. So, but most of the money has actually gone into the early stage and the late stage. So if we talk particularly about early stage, actually dominated in terms of volume, whereas you know, later stage actually dominated in terms of value. But there was, you know, completely lacked in terms of, you know, growth stage, where both value term and volume term, it was lacking over there. Hardly, you know, $500 million with barely 50 deals. So this is the missing middle, basically, we call valley of death, you know, where the funding is not there at all. And it's such a crucial juncture where the companies in this particular sect, they actually lack scalability, correct? Because they require funding. And at the end of the day, if we support these companies, then, you know, these companies can actually provide a sustainable emission solution to the company. So this is what it is.
In fact, you were mentioning a very interesting statistic some time ago about foreign money versus domestic capital pools. Would you mind talking about that particular statistic?
See, again, it depends on the risk appetite. Like Mohit mentioned, you know, at the end of the day, every investment has to work out. So obviously, you know, from the risk appetite point of view, domestic LPs are more risk averse than the global LPs. So that is the reason why more global capital has flown in this climate tech space as compared to domestic capital. So the idea is that, you know, again, if we talk about the missing middle itself, see, the companies which are actually falling into this criteria, say, they both require capital, you know, at some certain point of time. It's not about that, you know, they need to first take the capital and then grow. It actually requires over a period of time and then, you know, entire growth part. Like, for example, in our new fund, you know, we have not invested basically into companies. We invested into developing the sectors. So we actually, you know, invest into the entire spectrum of the growth journey of the companies, but we have not taken the technology risk and the product risk. So we believe that the companies which we are investing into, they are capable of, you know, both in terms of capability and ability, they can generate cash flows. So this is what actually, you know, I mean, entire spectrum, we feel that, you know, this is particular point of thing that we need to address into.
Rajiv ji, I'll come to you. They say that the middle overs actually holds the key to the entire match. And Rajiv ji, you come in the middle overs, if you will. MSMEs actually hold the innings together. Sometime back you were telling me that SIDBI has supported 15,000 MSMEs through green loans worth 15,000 crores. I think that's quite substantial. Where does the MSME climate adoption landscape, what does it look like today? And you know, where is the traction very strong? Where are the gaps? If you could just give some insight on that.
Thank you. First of all, thank you IVCA for having me here. Green and climate change, and we all know it impacts everybody. And it impacts majorly to those people who are most vulnerable. And our micro and small sector falls into that. SIDBI has understood that if we are not able to sensitize these micro and small industries and medium industries to convert and become greener, we'll be in trouble. So this realization came to SIDBI, and we have been working towards that. And that's why, we have, in fact, I have also been involved in a couple of World Bank projects wherein we have been working in the clusters to make these MSMEs energy efficient, to help them conduct their energy audits, adopt better practices, and then give them loans. and we have, I mean, we have created a portfolio of more than 15,000 crores of green loans, and which has been given to more than 15,000 MSME borrowers. These are normal term loans which are given at a concessional better terms. So one is that giving traditional loans to MSME. So when so basically, I mean, what I am trying to convey is that one, MSMEs are impacted in a big way from this, from the climate change. Second, MSMEs also are emerging as a solution provider to the entire climate change problem. And two examples which we saw just before this panel, two startups, they made their presentation. They are they fall under MSMEs, they are micro borrowers. So we need customized financing in the form of venture capital financing for these kind of entrepreneurs. So SIDBI is very active, one in the traditional finance space. Secondly, in the venture capital space, we are also active. And in the venture space, again, we are active in the entire value chain, right from the seed stage. And presently, we have got MOUs with 18 incubators in the country, wherein we have placed a corpus with these incubators, and we are basically providing seed capital through these incubators to these seed stage investors. Thereafter, through our fund of fund, which we have been operating for almost 10 years now, we have channelized more than 10,000 crores and to around 160 AIFs, and which has leveraged another 80,000 crores. So total 90,000 crores has gone into various finance, to various startups. So, so in the venture space also we are there. Thereafter, when the startups are in the growth space and they need to protect their equity, so SIDBI is also in the area of providing venture debt. So we provide non-dilutive venture debt to the startups also. And recently we have launched our pre-IPO scheme for MSMEs, wherein we can provide equity also. So we are trying to, I mean, be there in the entire space, entire value chain, and gradually, as and when new programs are being announced, we are trying to work on those also and provide benefit to startups as well as MSMEs.
Rajiv ji, sometime back you were talking about a very interesting thing, the SIDBI's Green Climate Fund. I had made some notes with REC Trichy. I thought that was a very interesting thing which you were doing. If you mind sharing them.
Yeah, I mean, as I said, while domestic capital is very important, but we need to also source the foreign capital which can come into India. And then that foreign capital can be blended with our domestic capital so that the desired impact could be provided. Green Climate Fund, I think all of you must be knowing, it's a body of United Nations which has been created to provide funding for climate change projects in the world. So SIDBI is an accredited entity of that Green Climate Fund. We have been able to source funding for various projects from Green Climate Fund, particularly in the VC space. We have been able to source funding for one Avana sustainability fund, around 25 million from Green Climate Fund, then which SIDBI also topped up through fund of fund, and then after many investors came in. Similarly, very recently, one more project has been got sanctioned by Green Climate Fund, which was anchored by SIDBI. This is basically to set up a incubator, a dedicated incubator for climate change startups. So basically, I mean, we all would understand that for a climate change startup, they need different kind of hand-holding support, different kind of mentorship, different kind of equipments wherein they can test their ideas, make prototypes, etc. So we have been able to source funding from Green Climate Fund to an entity called TrekStep, and this is in the Trichy. It's a body of NIT Trichy. So TrekStep will be, it is already an accelerator incubator, but now they will be running a program focused purely on climate tech startups for, the seed stage funding, etc. And Tata Capital has also been roped in. Around 15 million has been reserved for Tata Capital to provide pre-seed as well as seed funding for these climate tech startups. So please feel free to approach TechStep, and in case there are any startups who want this kind of support, please get that. Thank you.
Thank you for sharing that, sir. I now come to Neha. And Neha, typically the coach and the captain watches from the pavilion and says, okay, opening overs ho gaye, middle overs ho gaye, abhi itne run banane hain, let's just unleash our firepower, okay, which typically means credit, which typically means scaling up.
I love the cricket analogy, Vikas.
Sorry?
I love the cricket analogy.
So you're talking about institutions coming in. What are the key trends you're seeing in climate financing today, and who are the major actors, and how are foreign and domestic institutions behaving? If you could just throw some light on that. And before, if you can just introduce yourself.
Yeah, thank you. And I'm not cricket intelligent at all, but I will like to participate in this match. So my name is, of course, Neha Kumar, and I represent an international not-for-profit climate bonds initiative, and the middle name of Climate Bonds Initiative, which is the bonds, explains what I do. We are very actively involved in market development, in the debt capital markets. Generally, you would have heard of green bonds and various kinds of thematic structures, which are basically debt instruments, trying to find and be directed and put to work for climate solutions. This is what we do globally. Having said that, of course, we work on policy advice as well to see how the ecosystem can develop. And there I will come in on what we are seeing in terms of trends. While my co-panelists talked about private markets, I will, of course, focus on public markets and the funding that is also required, because climate investments, if I could put it like that, then this is a debt-heavy universe. You take power sector as a proxy, you would generally find that it is 70% debt to 30% equity ratio, and that is a sort of a proxy that we can take for the entire market in terms of climate investments. So I will do a couple of trends initially. India and Indian issuers, people who are raising finance through bond structures, they are raising, most of the demand is coming from offshore investors. Remember that domestic investors are not so discerning or rewarding about a label. And when we talk in this category, label becomes everything. It is the label that gets you perhaps low cost of finance. It is the label that gets you a greater and closer dialogue with investors. Investors get attracted to you because you're labeled. Okay, so there's a different, this is a different class of investors who are trying to chase green projects. So as I said, demand is coming from offshore. So who are these people who are raising money offshore? These are large companies generally. These are not only Renews and Green Co's, but these are also NTPCs of this world, JSWs of this world, who have raised a lot of money. And as of 24 end, we had about $55.9 billion issued. So that will sound like a reasonable number, but I would say that India and its climate finance needs is still a suboptimal number. You look at China, it is 10 times higher. We are fourth largest in the emerging economy world. South Korea and Chile are ahead of us. But the way we need to progress and finance the energy transition. Also, not only energy transition, I would go back to the previous panel, also adaptation and resilience, absolutely critical. So we need much, 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 much more. Which sectors is this coming to? It is coming to the mature sectors of RE, you know, utility scale RE. It is coming to transport, but RE is basically the dominating sector. Nearly 78% of these funds are flowing into that sector, only about 8% to the transport. Huge opportunity, absolutely huge opportunity of growth. The other thing that I wanted to mention was that there also now, the sovereign green bond issuance is a very important marker, because generally all over the world, these set the benchmark pricing. They lead to corporate debt coming into market. The fourth aspect is you're also seeing some debt-focused funds. Vivriti Capital is there. You know, they are smaller funds. They're looking at MSMEs, but we have these funds emerging. And all of these, I think, put together show that there is a huge room for growth. But at the same time, domestic investors are not as active as they should be. And international investors, of course, great. We want international capital, but there are risks associated. There is currency risk associated with it. There is also refinancing risk associated with it. So I would say that unless we actually unlock domestic pension funds, domestic institutional investors, I think the gap that we are seeing in terms of financing will not be able to bridge that in an effective manner and at speed and scale that we need.
Very interesting. Since you're not a cricket aficionado, I would probably use Hollywood. I think you're talking about bond, climate bond, right? But just to take off from where you left, Neha, I think Satish also alluded to the domestic versus global investor conundrum here. Let's start the second innings with you, and from the point you just left off. What are the biggest challenges at this point of time stopping large institutional investors, you mentioned pension funds, insurance companies, from entering this climate finance early enough? What is stopping them from doing that? And sorry, the second part is what structural solutions would you propose?
Yes, absolutely. So I'll just step back a little. You know, we had beautiful examples of businesses which are becoming circular, recycling, okay? And I think climate-led economic growth and business growth is not you cannot see it in isolation. You cannot see it in silos. It is a transformational moment for India. So we need a financial system, not a financial strand, okay? We need a financial system that can scale rapidly, okay? And I think circularity of finance is important for that matter. I think this is also what we are talking, how one financing cycle finishes, exits, and the other one comes in. Equity leaves, debt comes in. I don't think that is happening in the sense that it should happen. So again, borrowing, debt is all about borrowing, right? And that would also mean that how much room do our companies have to borrow? How much room does our country have to borrow? So somewhere public finance also comes into play. You know, it is a catalytic feature. You cannot basically say that, you know, public finance is all that is required. We need private finance, but what role will public finance play or state play in attracting private capital? So the essence of the story is that we need more and more private capital. That's not coming in, so we need to crowd that in. Now, when we talk about circularity of capital, and this is not my idea, it is being growing, and I would credit it to our former finance secretary, Mr. Arvind Mayaram, who has been talking and making this more of a case. Basically, the idea is simple, that state takes some of the risk. Private capital comes in to, for projects that have already reached scale. Investors come in through structures which do not add debt burden. And here, for example, InvITs, these are structures, you know, they purchase and they provide liquidity. and then the returns go back to the concessional lender or the public, okay? What is happening? What is happening is that you're moving from private to public, or public to private, in this case, public to private. You're moving from equity to debt and back again. And this circularity is needed. Right now, banks are taking a lot of exposure. They needn't. Capital markets need to come into play, okay? Now the second, what does it do? It actually, the circularity, the cycling of capital also reduces financing costs. It also then widens access. The second question, how can pension funds come in? These are pension funds. Institutional investors can actually do invest in InvITs. The other thing that I must say about pension funds is, now they have a regulatory barrier to enter into, lower rated investments, which is AA and below. So one way is that, okay, you need regulatory reforms. I think that is not the way to go forward, because you will keep on coming to a wall, okay? What we need is financial structuring. Can we structure, can we securitize pools of debt, make it investable with credit enhancements, because that's what we need more and more in Indian domestic market, investable, attractive for pension funds. And that, I'm sure that pension funds will be able to invest in that paper, and that needs to happen much more.
Interesting. I think one thing we can talk about the entire financial ecosystem, if you will. We are fairly adaptable and we move fairly fast. So I think these are some very useful suggestions. Rajiv ji, I'd like to come to you now. You've talked about MSMEs, and MSMEs are central to India's green transition. We are seeing a lot of activity there. Yet a lot of them struggle with adoption. Okay? What are the biggest barriers on the ground that you see, considering your extensive focus on this, and which catalytic solutions or ecosystem enablers can unlock MSME scale climate adoption?
Biggest barrier is awareness and sensitization. So, because these are fairly spread in various clusters, and it's a very heterogeneous kind of, from a very micro, small unit to a medium unit. So, it's very difficult to reach out to everybody and convince them to adopt green, so that you become more sustainable, more profitable. This issue is basically, we have been trying our level best to reach out to various clusters. We are conducting various cluster level programs from time to time, so as to create that awareness, sensitization amongst them. Moreover, because the technology cost is higher, if they adopt any green technologies, the cost is higher. So basically convincing them to invest higher amount in a better technology as compared to some technology which is cheaper, but not green. So that is again difficult. So for that we need, instruments which are, blended instrument wherein we need to create structures, we need to create, sort of a carrot for them, so that they get interested to adopt those measures. SIDBI is doing a lot of programs. In fact, we are going to smallest of the clusters. Like, for example, one example I would like to quote. We ran a program in Moradabad. Moradabad, it's a cluster of artisans who work on brass. There are more than 50,000 small artisans over there. And they have furnaces in their homes, and these are coal-based furnaces. Their wives, their children, everybody is involved, because these small furnaces are in their home. And because of burning coal and all these, they have all these problems with regard to their health problems, lung problem, everything. So we run a program wherein we place certain agencies to first sensitize them, then educate them, and then basically incentivize them to uh, adopt better furnaces, clean furnaces, gas-based furnaces. So we have been able to convert more than 200 gas-based furnaces now, and now people are getting to understand what are the benefits of adopting gas-based furnaces. The environment is lot much cleaner and better. So, so I think we need many more such programs in various clusters. We are going to run another program for these sugarcane farmers. Basically, the micro entrepreneurs who make khansari good. So these are also very small micro entrepreneurs who adopt very poor practices and use lot of diesel, burn bagas and all those things. So if we can help them to adopt good practices, maybe we will be able to convert them. We are going to start a program very recently on that.
That's fascinating hearing such micro stories, if you will. And I can just give a suggestion, and it's a very lateral suggestion. Please don't kill me for it. I'm like Ravi Shastri, so you can please excuse me. I can say whatever I want and get away with it. But one of the things we've seen in the asset management business, one of the growths in retail participation has happened because way back in 2015-16, the regulator mandated that 2 basis points be set aside for investor education. Okay, and that has now gone up. I mean, if you see the SIP flows and all of that, it's turned into a bullet train, if you will, coming in. I think something like that, if there's a pool of money which is into awareness and sensitization, the 2 words that you use, I think it will eventually realize in demand, and then demand will create supply in terms of instruments. Like I said, a lateral suggestion.
Yeah.
So that is what it is. So talking about laterally, I'll move lateral here. Satish, I'd just like to ask you, you've been very passionate about this business, and you worked earlier in private equity, and now you're looking at credit as well. Very simple question for you. How do we activate domestic LPs in climate investing?
So, I mean, this is very tough question, but but I just want to build a theory upon what Sir has told. See, there are certain challenges, you know, as an LP. I've been in my career throughout an LP and supporting not less than 100 AIFs and then direct investment and co-investments. But especially in climate tech, there is a nascency and, you know, lack of market adoption actually, you know. The reason is that, you know, companies in this stage basically, they prove they are lack of, you know, scalability, then, you know, the lack of market size and all other issues are there. So, and one more thing also, there is lack of awareness also about the product and the application of the technology. That also actually delays adoption quite a few times. So, investor, like, you know, some of the spectrum that we invested into, right from writing 1 crore or 5 crore checks to 200 or 400 crore rupee check. So, basically, investor can employ 2-pronged strategy, creating, you know, or creating market linkages for these companies, and then capacity augmentation providing for these companies. Because one thing that we need to be very clear about, climate tech companies or environmental tech companies, they have very long gestation period, unlike your consumer tech companies and BFSI and all that. So investors, you know, risk appetite is higher, and that is why they are more cautious about it. Very selectively they do that. And second thing is about, like ma'am spoke about the regulatory part. You know, most of the money which has gone into solar and EV, correct? Why? Because there were policy announcement, there was support, like for example, renewable energy through Solar Energy Corporation of India, and EV through FAME policy, and now Prime Minister E-Drive. You know, so a lot of funding has been attracted when the government policy has been supported this. So, but what about the other sectors? You know, they only been financed or funded into the early stage, and there was no funding for growth stage and the late stage.
Interesting. So actually, I'll close the batting with you, Mohit. While we were discussing some time back, You were pretty much alluding to what Satish has been talking about. You mentioned a very interesting statement, which is still in my mind. You mentioned that climate tech outside solar and EV often becomes a graveyard of failed startups. Okay, that's a very grave statement, but I think that's a very apt
It's
statement.
long and wide.
Sorry?
The graveyard is long and wide.
Yeah. Uh, what forward-looking solutions, looking forward, what forward-looking solutions, new business models, or collaborative approaches do you think will create more investable and resilient climate opportunities?
Ultimately, private capital is, it is what the name suggests is, it's capital, somebody else's capital that needs to be managed. And hence, my fundamental belief is let capitalism prevail. So essentially, we will have a lot of business ideas that will go through the incubation journey, venture capital funding journey, and private equity funding journey, at some point debt funding journey. And the ones that are sustainable will survive, and the ones that are not will become lessons for the next generation of climate tech companies to come. And that journey is on. While I fully support the the conversation that we've had up until now about creating awareness. Awareness essentially brings entrepreneurs to these pools of capital. Beyond that, and you can have some level of government supports, a version of PLI for investors to feel more incentivized to invest in the sector. But beyond that, essentially let the capital markets operate, right? And like I said at the top of the conversation, over the years, I'm starting to see that all the companies that went through that graveyard essentially have created a very important set of lessons for the follow-on entrepreneurs to follow. Like you are seeing, we were talking to founders outside when they were presenting their companies. There is a focus on unit economics. There is a focus on delivering scale beyond R&D. There is a focus on delivering customer value proposition, right? So all of those things are at the heart of any good, strong investment decision. And what I'm very, very heartened to see is that the climate tech entrepreneurs or the decarbonization entrepreneurs are not just dependent on government schemes or incentives to build their business model. They are very real, sustainable businesses in themselves, which as the country and the globe is going through the sort of evolution of infrastructure, in this next sort of evolution of infrastructure, the next set of products, services that will get utilized will have a strong decarbonization element to it. And I'm heartened to see that they will have a very strong unit economics and a business model associated with them. So long and short of it is, let capital markets do their work, and which they seem to be, and the businesses now we are seeing are far more self-sustaining than be dependent on somebody else's capital.
It's a good closing statement. In fact, I don't know whether we have enough time for any questions. Time up. Okay, so I'll just make a closing statement here. You know, every time India goes into bat in a World Cup, we expect it to win, right? There is no tournament which we enter where we don't expect to win. But I think winning requires efforts at every stage. Each league stage, semi-final stage, final stage, you have to do that. The good thing is that there is always skepticism when India loses. Ki yaar, ye log to jeetne wale hai nahi. But that leads to further intensification of efforts, which makes us even more hopeful towards the next World Cup. So I think our panelists have very beautifully articulated some of the challenges and some of the opportunities and solutions which are coming in there. Thank you so much, panelists. It was a very lovely discussion.